Hi, Matt Connor here with Connor Management Group, and this week we're going to read to you another one of our blog posts that we think you'll find pretty helpful and informative. The title of the blog post this week is called Stock Option Basics, a Blending of Investing and Gambling. Alright, so here we go. The title of this post is Stock Option Basics, a Blending of Investing and Gambling. Now, just to be clear, we sometimes hear about an executive at a corporation receiving stock options as part of his total pay package. Those stock options are completely different from the ones we'll be talking about. The stock options we will be talking about are traded on major exchanges just like stocks. The purpose of this post is to teach you the hard and fast basics for learning to buy stock options. As mentioned, stock options are contracts you can buy and sell just like a stock or a mutual fund. Now, buying them is not as simple as buying a stock, but it's not complicated either. Buyers of stock options use them for different purposes. Some people use them like insurance policies to protect against existing gains they've made on stocks. Others use stock options as high payoff gambling opportunities. These people are often referred to as speculators. And then there are many who use them as a high payoff investing opportunity. That is a combination of an investment and a gamble. Those buying options as an investment or gambling opportunity are looking to make fairly quick profits by making bets on the direction of a stock's price by a certain date in the future. And this is what we're here to talk about: how to invest and or speculate by buying stock options. Onto investing and gambling was the header. Now, when you hear the word speculate or bet, you naturally think of Las Vegas, and you should. In the world of stock options, you can lose your shirt almost as quickly as you can in Las Vegas if you don't know what you're doing. But as the word speculate or bet imply, there is the opportunity to make substantial returns. What is especially attractive about stock options that many overlook is that you can choose how risky of an investment or gamble you want to make. Unlike at a roulette table, you truly have some control of the odds of the game. But again, just to be clear, you can also lose all of your money, and if anyone ever tells you otherwise, they are lying. No ifs, ands, or buts. Additionally, another attractive feature when it comes to buying options is that your homework can improve your odds of a modest, favorable, or very favorable payoff. Yes, there's still an element of gambling. However, by doing research, like for a regular investment, you can make your option contract purchases more of a well-researched investment opportunity and less of a speculative gamble. Some basic concepts. Stock options are contracts that you can buy and sell just like a stock. So when you buy stock options, you're buying what are called option contracts. These contracts are very simple and straightforward. The same online services you use to buy stocks readily allow you to buy option contracts. E-Trade, Schwab, Interactive Brokers, all the major online brokerage firms allow you to buy and sell option contracts. There are only two kinds of option contract. One is called a call option contract. The other is called a put option contract. Okay, concept one. You buy a call option contract when you want to bet that the price of a stock is going to go up. You buy a put option contract when you want to bet that the price of a stock is going to go down. Concept 2. A call option contract gives you the right, you don't have to buy a specific stock at a specific price anytime before the contract's expiration date. A put option contract gives you the right, you don't have to sell a specific stock at a specific price anytime before the option contract's expiration date. Concept 3. It costs money to buy a call or put option contract. You're not required to do anything after you buy it. The contract can expire and be worth something or nothing. On to the next section. Call option purchase example 1, an introduction. Okay, so here's an introductory example. Let's say it's April 2nd, and suppose we did some research and are confident that Microsoft stock is going to go up over the next 2 months. Since we expect the stock to go up and we're looking for a fast, significant return, we then know we want to buy some Microsoft call option contracts. Next, we have to choose one of the many Microsoft call option contracts available for sale. Well, first off, we should know the current price of Microsoft is $40. Again, a call option contract gives you the right to buy a specific stock at a specific price before the option contract date. The specific price is called the strike price, and it does not change. So if we're going to buy an option contract for a particular stock, we have 2 additional choices to make. The option contract's expiration date / month, and 2, the option contract strike price. So stop and consider this for a minute. The option contract is going to have a certain cost right now, so the market price of a call option will go up if the stock price goes up. That is, the stock price is moving further away from the strike price. After the expiration date, if a buyer has not sold his or her option contract yet, the contract is either worth something or it is worth 0, nada, nothing. Now, what determines if it's worth something? Just keeping it simple, it mostly depends on the change in the price of Microsoft from the time you bought the contract. So again, purchasing a Microsoft call contract specifically gives you the right to buy Microsoft stock at a certain price before the option's contract expiration date. Let's say the date for some Microsoft call option contract you bought is in June, and it's in about 2 months. And let's suppose that the terms of the contract you bought gave you the right to sell Microsoft at $45, the strike price of the contract. If the price of Microsoft is above $45 at or before the expiration date, then the value of the call option contract will be worth something above $0. How much will it be worth? Depends primarily on how much greater the price of Microsoft is above the $45 strike price. The greater the amount of Microsoft above the strike price, the more valuable the price of the call option contract has become. However, if the price of Microsoft is below the strike price just before or on the expiration date, then the value of the call option contract is 0. The option contract expires worthless. Now, just to be clear, after you buy an option contract, you can turn around and sell it at any time before its expiration date. It's really all about personal greed. Personally, I have bought and sold many contracts, holding them for as short as 5 days and others for as long as 4 months, sometimes expiring worthless, other times more than doubling my initial investment. So to summarize, once you decide you're going to buy option contracts for a specific stock, you have 2 choices to make when selecting a contract. 1, the strike price, and 2, the expiration date. Okay, going on to the next section. Call option purchase example 2, real world. In this example, suppose Microsoft is trading at $40.25, and your research leads you to believe the stock is going to go up. Your research also leads you to a recommendation to buy Microsoft call option contracts with an expiration date of July 2014 and a strike price of $39. When you go to place the order, you would find a bid price and an ask price for this option contract, just as you would see a bid price which you could sell it for and an ask price which you could buy it for, just as if you're buying a stock. So for this option contract, you will find that the bid ask at $2.44 and $2.47. So the cost to buy one call option is the ask price of $2.47. Now, another thing to know is that each and every option contract is only sold for control over 100 shares of a specific stock. Therefore, each option contract will cost you $2.47 times 100 shares, or $247. So when you see the bid-ask prices, just multiply them by 100 in your head. This is the cost for one option contract. On to the next section, strike price and expiration date selections. Why choose a particular strike price and expiration date? The short answer is experience. The longer short answer is risk and reward. Until an investor / speculator gets more experience, we recommend the purchase of what are called in-the-money stock options. This means that if the contract date were accelerated to your purchase date, the contract would have at least some value to it. In option textbooks, this is referred to as the option contract's intrinsic value. A little more practically, for call option purchases, this means choosing an option contract where the strike price is less than the current stock price. For put option purchases, this means choosing an option contract where the strike price is greater than the current stock price. Regarding which expiration dates, we recommend choosing options that have an expiration date between 4 and 9 months. By purchasing contracts with longer times to expiration between 4 and 9 months, we think allows a tolerable level of volatility for a beginner or moderate risk option purchaser, while still allowing for large percentage increases as well as possible large percentage declines. Many investors and speculators can and do choose options that are not in the money, referred to as out of the money, and may expire in weeks rather than months. However, the volatility of the value of these options are substantially greater, as is the payoff or the loss. These are truly Vegas-style types of bets. If you're picking your own strike prices and expiration dates for a particular stock, a great resource for selecting them can be found at www.optionmonster.com. That's www.optionmonster.com. You can go to this website and put in the ticker symbol for a particular stock, and you can see the option contracts that are available to buy and sell. You'll find that strike prices are available at different incremental levels. You'll also find that the expiration dates and months are not available for every month, but usually available for expiration dates within the next 2 months. Additionally, here's something to know about expiration dates. The expiration date for options for a given month moves a bit from month to month. This is because for any expiration month, the expiration date is the third Friday of the month. Most of the time, you don't need to know this date for placing orders. The assumption is that when you buy and sell stock option contracts, you already know this is part of the game. Now, everything we just told you about call option contracts also applies to put option contracts. However, you're just betting for the opposite direction of stock movement. Up to the wrap-up section. Now, listen closely. Investing in stock options really can be effective staying this simple. Many professionals and training organizations will try to convince you that if you invest in options, you need to be familiar with option combination structures known as spreads and or straddles. These structures limit option contract payoff upsides and downsides. It is our firm belief that it's best to just keep it simple. It is our belief that if you cannot draw a clear conclusion from your homework and research to comfortably buy a call option or a put option, then just don't buy anything. Just wait for the better opportunity. Just in case you want to know what makes us pick a particular stock, well, we use our own self-developed proprietary algorithms to review, analyze, and rank over 3,500 stocks every week. We use a widely known investing approach called value investing the approach is used by Warren Buffett and many other successful investors. Those stocks that are ranked among the best are great candidates for purchasing call options. Those stocks that are ranked among the worst are great candidates for purchasing put options. So we hope you found this post helpful. And if you're looking for a source of specific weekly call and put option recommendations, please consider subscribing to Counter Management Group's premium newsletter. You can find out more by visiting us at www.cmgstockpicks.com/premium. That's all we have for this week, and we hope you found this presentation helpful, and we'll talk to you soon. Take care.